Not all property ownership types are created equal. Choose the wrong one, and you could end up sharing ownership with someone you never expected, paying unnecessary taxes, or creating legal problems for your family. Buying a home? Know these 10 ownership types first. Part 2. Let's start with ownership structures designed for people who own property together but are not married. These are common for friends, siblings, business partners, or investors purchasing real estate together. The first option is joint tenancy. With joint tenancy, every owner has an equal ownership interest. For example, 2 owners each own 50%. 3 owners each own 1/3. Even if one person contributed much more money than another, ownership must still be divided equally. The biggest advantage is the right of survivorship. If one owner passes away, that person's share automatically transfers to the remaining owners. It doesn't go through probate and it doesn't pass to the owner's children or heirs. This makes joint tenancy popular for people who want ownership to transfer automatically. However, there are trade-offs. Because ownership must stay equal, it's not ideal if each person contributes a different amount. Selling can also become complicated. In many situations, major decisions require cooperation from the other owners. From a tax perspective, only the deceased owner's share generally receives a step-up in basis. The remaining owners keep their original tax basis, which could result in capital gains taxes when the property is sold. The second option is tenancy in common. Unlike joint tenancy, ownership percentages do not have to be equal. For example, one person can own 40%, another can own 60%, or any percentage that everyone agrees to. This flexibility makes tenancy in common very popular among real estate investors. Another important difference is inheritance. When one owner dies, their share does not automatically transfer to the other owners. Instead, it goes to their heirs through their will or according to state inheritance laws. That means you can leave your ownership interest to your children instead of the other co-owners. Still, it has downsides. Because multiple people own different percentages, disagreements are more common if expectations aren't clearly documented. Imagine buying a property with a friend. Years later, your friend sells their ownership interest to someone you've never met. Now you're suddenly co-owning property with a stranger. That's why written agreements beforehand are extremely important. Taxes are also divided based on each owner's percentage. Someone owning 40% generally pays taxes based on their share. Only the deceased owner's portion may receive a step-up in basis. And depending on how ownership is transferred, gift tax or transfer tax could also apply. Another option is partnership ownership. This structure is commonly used when 2 or more people invest together as a business. There are 2 common types: general partnership, limited partnership. Instead of owning property personally, the partnership owns it. This can simplify business operations and investment management, especially for larger real estate projects. The exact tax rules depend on how the partnership is structured, so professional advice is usually recommended. LLC or corporation? Choosing the right ownership structure. Now let's look at ownership through a legal entity instead of as an individual. The 2 most common choices are LLC and corporation. Although both are business entities, they work very differently. First is LLC. An LLC is one of the most popular ownership structures for real estate investors. Instead of the property being owned by you personally, it's owned by your LLC. One major benefit is asset protection. If your LLC is properly structured, your personal assets are generally better protected from liabilities related to the property. LLCs are also flexible. Adding or removing members is usually much easier than changing ownership on a property's deed. There may also be tax advantages because many LLCs are treated as pass-through entities, meaning profits pass directly to the owners instead of being taxed twice. However, LLCs aren't free. You'll usually have formation costs, annual filing fees, accounting expenses, and possibly franchise taxes depending on your state. You'll also continue paying property taxes, and transfer taxes may apply when ownership changes. So while LLCs offer excellent flexibility and protection, they're not the right fit for every property owner. The other type is corporation ownership. This structure is more common for larger investment companies or professional real estate businesses. A corporation owns the property, not the individual shareholders. The biggest difference is taxation. A C-corporation may be subject to double taxation. First, the corporation pays tax on its profits. Then shareholders may pay tax again when profits are distributed as dividends. An S-corporation can avoid some of that double taxation. but not every business qualifies. Depending on the company's development requirements, sometimes you can't choose between C-Corp or S-Corp. For most individual homebuyers, a corporation is usually not the first option. 5 property ownership facts every homebuyer needs to know. Before we wrap up, let's review the 5 biggest lessons from this series. First, think about who will own the property. Some ownership types are designed for one person. Those are sole ownership and trust, while others work better for married couples. It could be community type or tenancy by entirety. Multiple owners could be in the form of a trust or a tenancy, or even businesses like partnership, LLC, and corporation. Choosing the right structure starts with understanding who will own the home and how you plan to use it. Second, consider what happens after someone passes away. Only a few ownership types allow property to transfer automatically without probate, including certain trusts, joint tenancy, community property with right of survivorship, and tenancy by the entirety. If avoiding probate is one of your goals, this can make a huge difference for your family. The remaining types don't have it. You must follow the will or go to court. Third, don't overlook asset protection. If you're worried about personal liability, ownership structures like a living trust, an LLC, tenancy by entirety or corporation, may offer stronger protection than holding the property in your own name. Fourth, understand the tax consequences. Every ownership type is treated differently. Some provide better estate planning opportunities, while others offer step-up in basis benefits or different capital gains tax treatment. There are 2 types, including tenancy in common and corporation, which cannot be stepped up in basis. Finally, think about flexibility. Some ownership types require everyone to own equal shares, while others allow different ownership percentages or make it easier to add, remove, or transfer owners. Community property cases, tenancy by entirety, and joint tenancy are also divided equally, lacking flexibility. The best choice depends on your financial goals, your family situation, and your long-term plans. The bottom line is that there isn't one ownership type that's right for everyone. If you want simplicity, sole ownership may be the best fit. If your goal is to avoid probate, a living trust could make more sense. If you're investing in real estate and want stronger asset protection, an LLC may be the better option. And if you're married, ownership structures like community property or tenancy by the entirety may provide valuable tax and inheritance benefits. Before you sign your closing documents, make sure you understand the ownership options available to you. A decision that takes only a few minutes today could save your family thousands of dollars, and a lot of legal headaches in the future. If you found this video helpful, please like, subscribe, and leave a comment below. I also have separate videos that explain each ownership type in more detail, so be sure to check them out and find the option that best fits your situation.
Real estate and mortgage broker Danguard, with experience in over 1,000 loan applications and real estate transactions, aims to provide you with useful and general knowledge about this field. For advice on each specific case, please contact via email or website provided below the video. Don't forget to click like and subscribe to the channel to stay updated with the latest information from Danguard.